It's Neil with you, and great to be able to welcome back to 2020 Gavin Martin. Welcome back.
G'day Neil, great to be with you.
Gavin, always love talking financial issues with you, and we are going to be taking some calls this hour, and we'll take calls on all sorts of different financial issues. But one thought that we had was if you've paid off your car, what would you do with the surplus cash that you used to put towards your car repayments? We'll talk about some wisdom as to how to allocate that cash. Perhaps you can tell us what you do with your repayments after you've paid off your car. Maybe you squander it frivolously on all sorts of unnecessary things, or maybe you've got a little investment strategy. Let's tackle some big picture stuff first, Gavin. The Reserve Bank came out with its minutes from its board meeting earlier this month. And there's some interesting things there. They always tackle the economic conditions around the world, and they talk about Australia's economic conditions. You've picked up a few little things that are not always in the minutes of the Reserve Bank. What did you pick up from the latest minutes?
Yes, the core message was that globally things are tracking along okay, and therefore the interest rates are able to be remaining as they are, so keeping them at the 2.5% rate. But there were a few messages there. One thing that they were concerned about is the rise in house prices, particularly in New South Wales, they mentioned. And if interest rates are low, it's good because it helps people go out and build new houses, and that's actually good for the economy. But they were concerned about, too much heat in the existing dwellings market, which can also be an effect of low interest rates. And so they were mentioned for the first time whether they might introduce some other strategies other than changing the interest rate to try and to deal with that issue of overinflated segments of the market. And in particular, they're talking about New South Wales residential property market. Okay,
this is where it gets interesting, because this is a little more complicated if they're using other means other than the interest rates to control those types of conditions. What did you pick up in the minutes?
Yeah, they called it macro-prudential tools, and I guess a sort of a buzzword for some strategies that other countries, including the UK and New Zealand, have used to try to tackle this particular issue. New Zealand have outlined there's four main mechanisms or macro-prudential tools that they've got. But one of the key ones that's quite easy to understand is the loan-to-value ratio. So the government could actually require that you have a certain amount of deposit when you go and buy a home, for example. So they're making sure that the loan to value ratio is of a certain level. And the example would be, say for example you buy a home of $500,000, they could require it that you have a 20% deposit. So if you're looking at a $500,000 property, 20% of that is $100,000. If you add then on top of that stamp duty, depending on which state you're in, it might be $120,000 that you need before you can actually go out and buy that home. Now that's going to take a bit of heat out of the market, because you can't borrow as much as you were previously. The government's not actually suggesting, or the RBA is not actually saying that they're going to do this, but they're saying that they might think about putting some of these mechanisms in place.
A lot of banks do seem to have some of those sorts of conditions on home loans where they require a certain level of deposit. But what you're saying is that that's not necessarily been set in stone, but the government could actually legislate to have that set in stone if the Reserve Bank leaned that way.
Yes, exactly. The structure that the banks work under at the moment is that they would prefer to have at least a 20% deposit or even more, because that means that their lending book is more secure. There's less risk involved with it. But if, for example, somebody wants to buy a home with only a 10% deposit, the banks often still allow it, but to mitigate the risk of default, they require that the purchaser have mortgage insurance. And so basically they're transferring some of the risk over to the mortgage insurer, whereas I guess this approach is more of a legislative approach to saying, no, you can't do that at all. Even if you're taking out mortgage insurance, you're not able to do it, and therefore it takes a little bit of a heat out of the market.